Most beginners think they need to trade crypto to make money, but the truth is, that's exactly how most people lose it. If you've ever felt confused, overwhelmed, or burned by hype coins and sketchy advice, you're not alone. Today, I'm going to show you how to build a beginner-friendly crypto portfolio that grows over time, without needing to trade, time the market, or gamble on the next meme coin. If you want a simple, safe way to start investing in crypto, this is it. Welcome to your stress-free path into crypto. In this video, I'll walk you through how to build your very first crypto portfolio. Even if you're starting from zero, no trading, no fancy charts, no guessing, just a clear, proven strategy that works. We'll cover everything. What coins to buy, how much to invest, where to buy and store it safely, and how to protect your portfolio from the market's wild swings. And here's the best part. You don't need thousands of dollars or years of experience. You just need a simple plan and a few smart habits. By the end of this video, you'll know exactly how to get started with crypto the right way, without falling for hype, scams, or beginner mistakes. Let's dive in. Before we talk about coins, wallets, or exchanges, there's one concept you need to understand, and that's your crypto portfolio. Think of your crypto portfolio like your financial cockpit. It's not just a list of what you own, it's your command center. Why is this important? Because in crypto, emotions run wild. Prices swing fast. Without a clear portfolio, you'll end up chasing coins, reacting to hype, and making random decisions. So, what exactly is it? A crypto portfolio is your collection of digital assets, like Bitcoin, Ethereum, or other coins. It shows you how much of each coin you hold, what it's worth, and how your overall strategy is performing. And how do you use it? Whether you're investing $10 a week or building a long-term position, your portfolio gives you the full picture. It helps you stay balanced, track your growth, and avoid overexposure to risky assets. Beginners who skip this step often feel lost, unsure, and disconnected from their investments. But when you treat your portfolio like a roadmap, not a lottery ticket, you make smarter, calmer decisions that compound over time. So where should you actually put your money? The crypto world has thousands of coins, and most of them won't last. That's why beginners lose money. They follow hype instead of fundamentals. Let's fix that. Start with the two giants. Bitcoin, the original cryptocurrency. It's limited in supply, globally trusted, and often called digital gold. Think of it as the most stable asset in crypto. Ethereum, the engine of smart contracts and decentralized apps. If Bitcoin is digital gold, Ethereum is the internet's financial backbone. It powers NFTs, DeFi, and more. These two give you exposure to both safety and innovation. Once you've built a foundation with BTC and ETH, you can explore a few high-quality altcoins such as Solana, known for its lightning-fast transaction speeds, making it ideal for scalable applications. Cardano takes a scientific, research-based approach to blockchain, focusing on sustainability and long-term development. Chainlink is essential in the crypto ecosystem. It connects smart contracts to real-world data, enabling powerful use cases. Avalanche offers impressive speed and flexibility, with a highly efficient platform for building decentralized apps, and XRP stands out for its ability to move money globally, fast and affordably, making it a favorite for international payments. These altcoins are popular for a reason. They solve real problems and have strong communities. But remember, in the beginning, less is more. Stick with Bitcoin and Ethereum until you're confident. This isn't about chasing trends, it's about building something that lasts. This is where most beginners go wrong. They skip the research, they follow influencers, they buy whatever's trending on Twitter, and that's how thousands of people lose their life savings chasing meme coins and overnight gains. Let's be real, coins like Pepe, Shiba Inu, and others might go viral, but most of them have no real use, no long-term value, and no protection against crashing overnight. Why does this matter? Because beginners often mistake hype for opportunity. Instead, look for coins with real-world utility, strong teams, and clear goals. This is where do your own research, becomes your best friend. Learn to check a project's white paper, study its use case, look at the team behind it, and see if there's real adoption. If the only reason someone's buying a coin is it's going to the moon, that's a red flag. Smart investors avoid hype. They invest in value. Your goal isn't to get rich overnight, it's to build something that can grow quietly while you live your life. So now that you know which coins to focus on, how do you decide how much to buy of each one? This is where portfolio structure comes in. And it's what separates thoughtful investors from random gamblers. Why does this matter? Because structure helps you manage risk. You don't want one coin dragging your whole portfolio down. Here's one simple model to start with. 50% Bitcoin for stability, 30% Ethereum for innovation, and 20% in a few strong altcoins, like Solana, Cardano, or Chainlink. Want something even more conservative? Try the 80-20 rule, 80% in large caps like BTC and ETH, and 20% spread across a couple of promising smaller coins. The key is balance. You're anchoring your portfolio in assets with strong fundamentals while leaving a little room for growth. Think of it like building a balanced meal. You've got your protein, Bitcoin, your veggies, Ethereum, and maybe a little spice, altcoins. And remember, if a coin isn't something you'd be proud to hold 5 years from now, it probably doesn't belong in your portfolio. Here's the strategy that separates smart investors from emotional ones: dollar cost averaging, or DCA. Why is this powerful? Because it removes the stress of timing the market, something even professionals struggle with. What is it? DCA means you invest a fixed amount of money, say $25, $50, or $100, on a regular schedule, like every week or every month. You buy no matter what the price is. Sometimes you'll buy when it's low, sometimes when it's high. But over time, you average out your cost and avoid emotional decisions. For example, $50 into Bitcoin and Ethereum every Friday. That's it. Simple. You don't need to check charts. You don't need to guess the bottom. And you don't panic when prices drop, because that just means you're buying more for less. It's like setting your crypto plan on autopilot. And here's the best part. You can start with whatever amount fits your budget. Even $10 a week compounds over time. The real secret? DCA turns volatility into your friend. And that's a mindset shift most beginners never make. Now that you have a strategy, let's talk about where to actually buy your crypto. This part matters more than people think, because not all exchanges are created equal. Why is this important? Because using the wrong platform could cost you in fees, security, or even access to your money. Start with trusted, beginner-friendly exchanges like these. Coinbase clean interface, easy to use, great for first-time investors. Kraken's solid reputation and lower fees for more experienced users. Crypto.com, great mobile experience and wide coin selection. All of these platforms offer secure environments and are widely used around the world. Once you open your account, there's one more thing you must do. Enable two-factor authentication, also called 2FA. It adds an extra layer of protection to your login and wallet access. And here's a pro tip. Don't store large amounts of crypto on exchanges long-term. Exchanges can get hacked. It's rare, but it happens. Your goal is to buy your crypto here, then transfer it somewhere safer. Which brings us to your next step. Where to store your assets after you buy. You've bought your crypto. Now you need to protect it. This is where most beginners make their biggest mistake. They leave their assets on an exchange and forget about them. That's like walking around with thousands of dollars in your pocket. One hack, one phishing scam, and it's gone. So how do you store crypto safely? You need a wallet. And there are two main types: hot wallets, connected to the internet. Great for convenience, but more vulnerable. Think mobile apps or browser-based wallets. Cold wallets, stored offline. These are physical devices like Trezor or Ledger, and they're your best option for long-term secure storage. Here's what you need to do. Get a hardware wallet. Set it up using the official guide. Back up your seed phrase, those 12 to 24 secret words, offline. Never store it digitally. Keep your device and phrase in separate, safe places. A hardware wallet is like your personal crypto vault. Once your coins are on it, no one can touch them unless they have your physical device and seed phrase. If you're serious about building wealth in crypto, this is a non-negotiable step. Investing is just the beginning. The real power comes from tracking your progress. When you see your crypto portfolio growing, even slowly, it reinforces good habits and keeps you focused on the long game. So why does this matter? Because it helps you spot trends, stay consistent, and avoid emotional decisions. Here's how to track your portfolio the right way. Use free apps like CoinGecko, CoinMarketCap, or CoinTracker. CoinGecko lets you manually track your holdings and price changes. CoinTracker syncs with your wallets and exchanges and helps with taxes. Set a weekly or monthly check-in. This keeps you engaged without falling into the trap of checking prices every 10 minutes. Record your DCA buys. Watching your cost basis lower over time is a powerful motivator. Tracking your portfolio is like looking at your financial dashboard. It helps you stay grounded when the market gets wild and reminds you why you started in the first place. Now that you've got the tools, the plan, and the strategy, here's how to make it work for you long term. These are the principles that help beginners turn into confident, consistent investors. 1. Start small. You don't need a lot of money to begin. Even $10 a week adds up. 2. Only invest what you can afford to lose. Crypto is powerful, but it's still volatile. Don't invest rent money. 3. Stick to the plan. The market will go up. It will go down. Your job is to stay consistent with DCA and stay calm. 4. Keep learning. Crypto evolves fast. Stay updated with trusted news, channels, and communities. 5. Think in years, not days. The people who win in crypto aren't the ones who move the fastest. They're the ones who stay the longest. This isn't about luck or timing. It's about consistency, clarity, and the willingness to play the long game. There's one more thing I haven't told you yet. Knowing what coins to buy is just the beginning. But do you know how to rebalance your portfolio, protect it in a bear market, or spot early signs of a scam before it's too late? If you want the full system, step by step, I've put together a free training that dives even deeper into beginner portfolio strategy, passive income, and smart crypto habits. Click the link in the description to join the free training now, and subscribe to the channel so you don't miss our next guide. This is the stress-free way to get started in crypto, and now, you're ready.